we still retracing, or have we stabilized?
Yeah, we're just stabilizing. That's what I see. Just ranging a bit, so pretty good for liquidity pools at the moment. So we're happy.
Yeah. Oh, I need to take this. I'm gonna go on mute for a second.
Yeah, sure. I can see some guys from the dojo, man. Nice, high float, high Sylvester. Nice to see you here, man. It's an honor, really. Is the sound from my side? Is it all right, or is it too strong? Not hard enough. Just let me know. Sounds good. Okay, perfect. I can see Daniel as well. Someone from our community. Hi. Good to see you here. Normally it's in French, but now it's in English, so always good.
Okay. I'm back.
Nice. Welcome back.
Tintin was holding down the fort. And Tintin, have you started recording yet?
I started recording, yeah. But I can just
Okay,
cancel it
great.
and go again if you want to. It's
No. That's totally fine.
the only thing is
Um,
I don't have the Discord recording, the Discord screen. I only have my screen. So I don't know if that's a problem or not, because I won't have like the chat recorded. I can read the chat though, but it won't record the chat.
yeah, I think that's okay. Will you pick up my voice and other people's voices? I
Yes.
think sometimes.
Yeah. No
Okay,
worries.
okay. Cool. Well, um, I'd say whenever you're ready, let's jump into it. Real quick, I think everyone in the audience already is familiar with this format here, but basically, every week we're trying to bring in someone from the community who has some advanced experience LPing on UniV3 or other concentrated liquidity venues. And I'm trying to pick people who have different perspectives on the market. For everyone in the audience, I mean, I think most of you are probably familiar with me, but my role at Aperture, I span a lot of different roles. And one of the things I've focused on a lot over the past year is doing the kind of trying to own the voice of the LP within our product discussions. So that includes everything from figuring out what product ideas we want to build, and also even down to like some small stuff with the UI and UX, where buttons should be placed, that kind of stuff. I try to represent the voice of the LP. So I've done a lot of conversations with LPs, and over that time, I've come to realize how diverse this group of investors is. And if you're on crypto Twitter and you're just looking at like what the academics are pumping out, the kind of like paradigms and the Uniswap research team, I feel like they give a very, how do you say, they make a lot of assumptions about the LPs and they miss a lot of the nuance. And so the purpose of this guest lecture series is to both educate people on general stuff within LPing world, but it's also a chance for all these guest lectures that are coming in to share their kind of unique take on the market, and how they make LPing on UniV3 or other places work for them. And so without further ado, I'm going to shut up and turn things over to Tintin. I'm very excited for this one personally. I'm kind of just going to sit back and watch myself. As always, throw questions up in the chat, and if you also want to come on the stage and have like a back and forth dialogue, with Tintin. You can also just raise your hand or DM me and I can let you speak. But yeah, I'm gonna shut up.
That's an awesome intro, David. Thank you for that. I don't consider myself a pro yet, so thanks for the invite. I'm really honored to do so. I come from a community where we focus on trying to give everybody the building blocks and the basics of something to really try and understand how something works, so that people can try and go adventure the jungle on their own and try and find new strategies based on these building blocks. And I think that is something that's so cool about crypto, that we can share so much with each other, and that everyone can just build together, share that information, and just get better together. So that's my mindset, and that's what we do in the French community as well. A few things before we start, just as David already said, just interrupt me whenever. English is not my first language, so if there's something that you don't understand, or if there's words that are a bit weird, just drop it in the chat as well. I'll be reading the chat if there's any questions there. So what I'll be sharing here today is my vision and a strategy. So my vision on impermanent loss. I don't look at impermanent loss like the theory states, and we'll go through that step by step. I'll start sharing my screen in a moment. And I'll share a strategy that I used to get a little bit of an intro in our community as well on how liquidity pools work. And then we'll use some free tools on the internet to do some calculations together to try and back it up with numbers, so that you guys can do it as well with the same tools. Then after that, I'll just share a tool that we made in Tradingview that does all these calculations for you already. But I really want you to know how to do it yourself first before using all kinds of automated stuff. I think that's really important. So on that note, if there are no questions on the intro or whatever, I'll just jump straight in. Let me see if I can share my screen. It should be all right. Tell me if you can see the screen changing to DeFi-Labs and Tradingview between the both of them. I think it should be all right.
Yeah, I can.
Yeah? Okay, so that's awesome. So a few things. I think most people here already know the basics of liquidity pools. The most important thing for me is, and if you want to dig in further, I won't dig in all the theory, all the formulas, etc. here. There's a lot of great videos, especially on the English side, for that. If you're French by any chance, I made some videos on YouTube as well explaining them. But here, I'll just explain briefly the rules of thumb. A liquidity pool, so it consists of a bottom range and a top range. If the price goes to the top range, you're in 100% of asset A. If the price goes to the bottom range, you're in 100% of asset B. Everything in between, it's the constant product market maker that rearranges the composition of the pool. So that's rule of thumb number one. Impermanent loss is something pretty complicated, and I'm going to try and make it as basic as possible. Impermanent loss, as theory states, is we're going to compare our liquidity pool's performance versus someone holding 50-50 of the assets. So 50% of asset A and 50% of asset B. In our example, we're going to make liquidity pools, and we're going to create them in the mindset of DCAing, dollar cost averaging an asset. So we want to accumulate the asset. Okay? So in our example, we're going to create a liquidity pool consisting of Ethereum and USDC stablecoin. So in our example, our impermanent loss would be that we would compare our pool consisting of Ethereum and USDC. We're going to compare it to someone holding 50% stables, so 50% USDC and 50% Ethereum. That is how theory states impermanent loss is calculated. And for the attentive people in the audience, this isn't really something that is, how do you say it, very current. I don't care how I perform against someone holding 50-50 because I don't know anyone just holding 50% of the asset and 50% in stables if someone wants to accumulate that token. So in this mindset, in the mindset of dollar cost averaging, we're going to compare ourselves to two other participants in the market. And I've put them here. And we're going to compare ourselves to the person that puts a limit order in to accumulate it. So this person is just going to wait. He analyzed a price where he's okay with buying the asset. So let's say, and this is, I won't get into the technical analysis part. Our community is full of traders. But I think everyone that is in crypto right now, especially in the audience, has a one way or another, and there's never a perfect way to do it. One way or another, you can analyze a good price where you're okay with accumulating it, where you would put a limit order in a centralized exchange or a decentralized exchange at the price where you would want to buy that token. So I'm not going to do TA, but let's say here is the breakout. We have some consolidation here, and I think around like the 2000 mark is a great price for me to accumulate Ethereum. So I state that I'd like to buy Ethereum at the price of 2031. I hope the screen is big enough so you can see it. Otherwise, I'm not sure if I can zoom in. But this will be our first market participant. This is one way to DCA. You can just put in a limit order in an exchange, wait for the price to go through that limit order, and you accumulate the token, and then you put it on your ledger, you leave it in your wallet, you've done your dollar cost average. That is limit order, okay? So that is the green, that's where we're going to buy it, where we want to buy. The second participant is the market buyer. And the market buyer, he just, whatever price it is, he doesn't really care. He buys every month or every week. This is like the most common thing to do. If you don't really, if you're not really a big technical analysis guy. And so what is he going to do? He is going to buy at the price of today. So I'm just going to put it in yellow. He's going to buy at the price of today. Maybe I'll put a little circle there. And he's just going to pray that price will go up. Okay, so these are the two market participants that will try and calculate the difference between me, so the liquidity provider, and the market buyer in limit order. So I don't really care how I perform against someone that holds 50-50 of the asset. So the theory we're gonna throw out of the window. We don't really care. We're gonna look at how we perform against a market buyer or a limit order. A market buyer, he will have 100% ETH because he goes all in Ethereum. He just market buys it, 100% Ethereum. And limit order, he stays in stable coins until price goes to his limit order. Is everyone still following there? I think until now it's pretty basic and it's pretty easy. So limit order is 100% USDC. He has it locked up in the limit order here. Now this is going to feel pretty arbitrary, but it's going to be, I'll clear it up later on. Let's say we're going to compare these two market participants if price goes to the red line. Okay, so if price goes up. Now what happens here? What we see is that if price goes up, let me see, where is the path? Let's do this. If price goes up, who wins? Who's the big winner? Well, the big winner is the market buyer, because when price goes up, he is completely into the market. He has 100% Ethereum. Price of Ethereum goes up, so he makes money because he's fully exposed to the market. But what about the second one, the limit order? The limit order is completely stuck. Because why? Because the price never went to his limit order. He still got his limit order in stables here, and he isn't exposed to the market when price goes up. So he's the big loser in this scenario. Okay? The opposite is true if price goes down. If price goes down and the market buyer here has bought 100% Ethereum at a price of 2.2K and price goes down, his dollar value, his portfolio value goes down. So he's the loser. Why? Because the limit order can buy more Ethereum at a lower price, then the market buyer has been able to buy at entry. Okay, so we can see here it's a pretty big duality. So price goes up, market buyer wins. Price goes down, limit order wins. Now you already see me coming, but an LP, a liquidity provider, will always be second. We will always be in between. We will never win, but we will always be second. So LP will always be in between the two. Why? It's pretty logical. If you it all makes sense if you think about it. We aren't 100% Ethereum or 100% stables. The pool consists of a composition of the two. At any time, when price is in between our range, we have a different composition of the pool, but we always have a little bit of stablecoins and a little bit of Ethereum. All right, perfect. Now, a pretty important thing that I wanted to share in theory as well is that when we compare ourselves to someone holding 50-50 of the assets, we need to really understand how a liquidity pool works. If price goes up, so let's say this is our top range and this is our bottom range, that means that, so if we open a liquidity pool, I'm gonna try and show it in a way, because I'm a visual learner, but let me try and find the right one. So we open a liquidity pool here, and I'm gonna give it a blue color. So we open a liquidity pool when the market buyer buys, with our bottom range at the price that we want to accumulate, and the top range is going to be a price that I'm going to explain why a little bit later. But so liquidity pools, how they work is the bottom range is 100% ETH, the composition of the pool. So here we are 100% Ethereum. And at the top range of the pool, we are 100% USDC or 100% stable. All right. This means that the higher the price goes, the constant product market maker, it's the CPMM we call it, it's an algorithm, it will sell the amount of Ethereum for USDC on the way up, and it will buy Ethereum on the way down. Okay? Why do I tell you this? Because it's pretty important to understand that when price goes up, the constant product market maker reduces your delta, your exposure to the market. So it reduces your exposure when the asset goes up, and it increases your exposure when the asset goes down. Okay? This is not something amazing, but it's the reason why impermanent loss exists. Okay? So the higher the price goes towards your extremes of your range, the more you'll lose, the more impermanent loss will be how to say it, important. Okay? This is important to note for later on, but the fact that the algorithm sells it in the wrong way, let's say it's in the wrong way, is the reason why impermanent loss exists. Okay? So your liquidity pool at the top is 100% USDC and 100% Ethereum. So you can already see that when price goes towards your limit order or towards your bottom range, your pool will be 100% Ethereum. So you will have accumulated Ethereum, you will be 100% ETH. You would have DCA'd in your position just like you would with limit order. And when the top price breaks, you would be 100% stable coins. Okay, so perfect. How do we see what the top range is? Well, the top range, basically how I look at it, and what my theory states, is that you want your top range to be at the price that you think if price breaks the top range, you are ready to move your limit order higher. Okay, so this is the analysis that you have to do in your head is, I have my limit order that I want to accumulate Ethereum at, but if price moves up and moves over this level, I think my analysis states that there's a less likely probability that my price will go to my limit order. I think it will go higher. So I'm okay with canceling my limit order and putting it at a higher place, at a higher price. Does that make sense? Because those are the two most important things to get, basically. How to calculate where to put your bottom range and where to put your top range. It all makes sense until now, I think. Okay. So David as well, you too, if you have any questions, just interrupt me whenever, yeah. Perfect. So we have a few scenarios here. So we know that when price goes down, it's the limit order that wins. And when price goes up, it's the market buyer that wins. And we know that the liquidity pool will be in between, right? We will have accumulated more Ethereum here. The pool will compose of more Ethereum at the bottom range than the market buyer could have bought here, but less than what the limit order can buy. So we'll be between the two. And when price goes up, our liquidity pool's value goes up less than the guy that is 100% Ethereum, okay? But more than the guy that is stuck in a limit order with his stable coins. Okay, so that does make sense. But now we need to calculate in these three scenarios. So there are a few scenarios, and I'll briefly draw them to make it visual a little bit better. Okay, perfect. So this is scenario 1, and scenario 1 is bearish action. So we start here, and we go towards the limit order. Okay, this is scenario 1. Scenario 2 is the opposite. This is bullish price action. So we break the top of the range. In scenario 3, it doesn't happen really often, but it does, it can, is sideways movement. In the future, we're exactly at the same price that we started. So I hope it's not too much of a chaos here with all the colors. But in short, you have three scenarios. Price goes down, price goes up, and price goes sideways. And now we're going to compare how we do it in the liquidity pool in all three scenarios and how all three market participants do in these three scenarios. So we already have I already explained who wins in every scenario. But how do we calculate how much do we have and what the difference is? So, am I forgetting something? We'll do it live in the tools later on, but I have the feeling I'm forgetting something. Yes, I'm forgetting something. So, we said that when price goes up, the market buyer wins, and when price goes down, the limit order wins. So, what is my vision on impermanent loss? My vision on impermanent loss is the difference between my value of my liquidity pool and the winner in each scenario. So the impermanent loss for me on the top range, let me see if I can, so IL top, so impermanent loss top, impermanent loss or divergence loss, it's the same thing. IL top is LP value, is market buyer value minus LP value. The difference between those two, for me, is impermanent loss. This is what I need to calculate. And IL bottom, so note that my impermanent loss is different in each scenario, okay? Because I always compare myself to the winner of each scenario. So IL bot is the winner. So here it's limit order, LO, value minus LP value. Okay, so I always compare myself to the winner in this scenario. But now we need to calculate that, and we need to bring those three scenarios into something physical, like into something real in calculations. So let's do this. I already made a little bit of room. All right. And then we're going to switch a little bit. It's going to be a bit chaotic. But the first one, and I think almost everyone here already uses it, but for the people that don't, and I had some questions in the DeFi Dojo as well, like how do you calculate the differences between these market participants in a decent way? And we use, until now, DeFi-Lab. I know a lot of people like Jay Call, etc., with his builder metrics, and you had him on as the first guest as well. He's trying to fix some tools as well. But Builder Metrics doesn't give us this possibility yet, but I know he's trying to program it in. For now, we still need to use this. I'm going to be honest, it's a bit clunky. It's a bit of a clunky tool. So bear with me. I'm going to try and explain the process in there. So again, guys, what we're going to do is we're going to calculate our impermanent loss, the difference between the liquidity pool's performance and the others. The other market participants in the 3 scenarios. Yeah, scenario 1 is bullish action, scenario 3 is bearish action, scenario 2 is sideways. So how do we do in every scenario? Okay, perfect. So we need to put in some data here, and I hope I can zoom in a little bit later, but I hope you can see all the numbers. Let me know if it's not. So our investments, we're gonna DCA 1,000 USDC. We want to buy 1,000 USDC worth of Ethereum. Just to keep the number simple, we use 1,000 USDC. At what price did we want to buy? Well, we're gonna look. We wanted to buy, this is the yellow line, at 2206.51. So we're gonna put that in DeFi-Lab. So 22.06 sometimes it's let's just say 22.06, because sometimes like the points and the commas, it doesn't really get it right. So 22.06 is where we want to buy. This is our current price. Don't really change anything here. That is for more advanced stuff that we'll if we have time we'll maybe look at later. Then here it's the minimum. This is your bottom range, and we said the bottom range was where we wanted to buy, which is 2031. 2031. That we put in the minimum. And the maximum, trust me guys, I have Tradingview here. We wanted to sell at 2438. It's 39. Right, first of all, which is pretty important, guys, if you followed along, you can see that these ticks, so these prices, they're not exactly what you put in DeFi-Lab. This has to do with the ticks. So this is again theory on how liquidity pools work. Liquidity pools work in you can supply liquidity only in ticks, so you don't have the exact price ranges. It will calculate the closest tick for your liquidity pool. It's not very important. Just know that well, if you want to dig into it, I can give you the right documents, but just know that this is normal, and the calculator will automatically just clip towards the closest tick. This tick will change as well with the fee tier you select, but that is all too much theory for now. I want to just give you the basics so you can start and discover stuff. So we've put in our bottom range, our max range, and our current price. Now DeFi-Lab will calculate all sorts of stuff. It will show you a lot of information on the liquidity pool you just created. And so I'm gonna try and zoom in a little bit. Let's see at the data that we need to find. Yeah, Aperture also just allows you to select ticks. Yes, and it completely makes sense, right? So it's important. Don't think it's a bug. It's a feature. So don't worry. All right, perfect. So we saw the calculator here. This is the calculator, but what do we need out of that calculator? What information do we need out of it? What do we need to search for? So we need to search for scenario 1. We're going to start with scenario 1. We need to search for the limit order, but we already know that. So the limit order has 1,000 USDC waiting there, okay? In scenario 1 in up, okay? It has 1,000 USDC still waiting in the limit order because price never went to a limit order, it went straight up, remember? So the limit order still has 1,000 USDC. How much does the market order have? Well, we can easily calculate that without DeFi-Lab. Let me see if I can bring this in. Let me just check, guys. I think I can. Yes, I can. Okay, perfect. You should see a calculator right there, if everything's good. Perfect. So the market buyer, he bought 1,000 USDC. So yeah, 1,000 USDC at the price of 22.06 Ethereum, which gives us, he was able to buy 0.453 Ethereum at that price of entry, remember? So we've got that as well. So he bought it at entry, so 0.543. And the price in this scenario, so we went to the top range, remember? So the portfolio value of the market order is now 0.453 Ethereum at a new price of 24.38. Okay, 24.38. So his portfolio value is now 1,105 USDC. That's what his Ethereum is worth. I hope everyone can follow until now. What we need to do now is we're gonna check what our LP value is in scenario 1. So what we're gonna try and look for in DeFi-Lab is what is the value of our liquidity pool in scenario 1. So if price goes up to 24.38, our top range. Let's see. So DeFi-Lab has a great composition tool where you can track the value of your pool depending on the price. So as we all see here, we start at nothing. Okay, we start at the price of 22.06, something like that. You can see the price normally is 22.06 USDC. That's the price. And you can see that the composition of the pool consists of 0.2507 wrapped Ethereum and 447 USDC. I hope everyone can see that. I cannot really move my my mouse cursor over there. But those are the prices you should see. Now, when prices goes up, you can see the composition of the pool changing, right? Because it is selling Ethereum for USDC, as I explained at the beginning. So price goes up, price goes up, price goes up until our top range is until we got to our top range, and you can see that the pool consists of 100% USDC, like we stated. And how much USDC is that? It's 1,029.25 USDC. You can see it here down at the numbers there. Hope everyone can see it. Okay, so your liquidity pool consists of 1,029.25. So that is what we can put in LP value. Our LP value is 1,029 USDC worth. So you can already see we did better than the limit order. We have 29 USDC more than the limit order, but the market order beat us by how much? Well, by 1,105 minus 1029. So market order had 1105. We had 1029. The difference is $76. All right. So he beat us by $76. The market buyer beat us by $76. So what am I going to do here? I'm going to put IL, impermanent loss, top is $76 USD, or around 7.6%. Do you guys understand that? I hope you do. So it's $76 is 7.6% of your starting capital, which is 1,000. So IL top is 7.6% for me. I need to beat an impermanent loss of 7.6% if price goes up. Okay? Now, we can do this, and this is just to share the mindset behind DeFi-Lab and how to do it. But DeFi-Lab has a very cool little trick here to the right, where it automatically calculates the impermanent loss. So remember, who are we comparing ourselves to in this scenario when price goes up? We compare ourselves to the winner, which is the market buyer, which is the guy that holds 100% Ethereum. Perfect. So here we can, DeFi-Lab gives us the opportunity to compare our strategy, which is strategy 1, versus someone holding 100% stables, 100% Ethereum, or 50-50. We all know now that 50-50, we really don't care how we do it against someone holding 50-50. We want to, for this scenario, we want to look at how we perform versus someone with 100% Ethereum. And this is going to calculate the impermanent loss instantaneously without you having to do the calculations that we just did. So we look at our starting price of 22.06. 22.0. Oh. 22. Oh, sorry. Yeah, 22.06. Okay, perfect. If you can all see it, the USDC price is 22.06 and the difference is 0%. This is logical because we started at 22.06. So in our scenario, price goes up. And so you will see the difference going up. You will see impermanent loss going up as well. What is our top range? We're going to look for our top range, which is 24.38, or the thing the closest to it. It's 24.48. This is the closest I've got. And there the difference is 7.28%. Okay? So what is the impermanent loss that we calculated? It was 7.6% because we took it the easy way. We compared 1,000 USDC, our starting capital, but now we need to compare our the capital that the liquidity pool had at the end. Okay, so this is more difficult to calculate, but DeFi-Lab tells us we have an impermanent loss of, what did we say again, guys? I think it was 7.28. Yes, 7.28%. 7.28%. So what does this state actually is that the market order has 7.28% more than us, the liquidity pool. Okay, so that is the impermanent loss there. Now we can do the same thing for the other two scenarios. I don't know if you guys want me to do it, because it can take some time. It depends on how much time you have. But basically it's the same concept. And so we'll have numbers for these three scenarios, and you'll see that here the market order wins, the limit order is last, and we're in between. You'll see the same thing happen in scenario 3, but here the limit order is going to be on top. So the limit order is 1,000 USDC. The market order is going to lose. Let's say he's going to have hypothetical 850 USDC. And we're going to have something in between. We're going to have 920 USDC worth of ETH. Maybe let me just show you really quickly how it is for the bottom side. So in the other scenario, we're going to look at our liquidity pool, like how much do we have when price goes down. So when the constant product market maker sells our USDC to buy more ETH, so you can see here, when price goes down, you can see USDC going down and wrapped Ethereum going up. Okay, so our CPMM, constant product market maker, is selling our USDC to buy more Ethereum. Basically dollar cost averaging, right? Until we have a 100% Ethereum when our bottom range is hit. So we would have in our liquidity pool 0.4619 Ethereum. All right, perfect. So let us put that in there. LP is let's just do the calculations. It's easier for people to understand. So 0.469 ETH. Our limit order. How much can our limit order buy with 1,000 USDC if price goes down, if price hits? So if price hits, and we're going to do the calculation again. if price hits the limit order as 1,000 USDC, and he's going to buy Ethereum at the price of 2031, our bottom range, he can buy 0.492 ETH. Okay, so limit order 1,000 USDC or 0.492 ETH. So we can see already that the limit order has more Ethereum than what we will have in our liquidity pool. But how much ETH will the market order have? Well, let's have a look. So the market order, he buys 1,000 USDC. So 1,000 USDC at the starting price, the price of the open, which was, yeah, you can't see it now, but here, okay. So the price of the open, we said it's the yellow one, it's 22.06. So he holds less ETH than us, right? Remember, we have 0.4619 ETH. Market order or calculation state, he has 0.453 ETH. Cool. Perfect. Okay, nice. So you can see here, limit order is first, because he has the most ETH. LP is second, we have the second most ETH, and market order is the last, and he has the least amount of Ethereum. So, as we stated, scenario 1, it's the market order that wins. Scenario 3, it's the limit order. We're always in between. Now, in scenario 2, when price goes sideways, of course, limit order still 1,000 USDC, price never hit. Market order is still, how much ETH does he have? So we said 0.543 ETH at 1,000 USDC. Because price is exactly at the same as where we started. And the LP consists, what did we say? We consisted of 0. Yeah, let's say, doesn't really matter, 0.7 ETH and 447 USDC equals 1,000 USDC. But I think, as everyone knows that is actually in this channel, I think that's the only thing that most people know. Even starting with liquidity pools, it's what draws everyone in there but gets everyone wrecked through impermanent loss later is the fees, because you generate fees as long as price is in your range. You generate trading fees, and that's of course why most people are here. So in this scenario, scenario 2, we will win. Why? Because we will have trading fees, so plus trading fees. And now we're probably at the most important part, or the most interesting part, is that, as you know, we have impermanent loss. Here, the impermanent loss will be, oh shit. So limit order. Here, the impermanent loss IL bot will be different, but we will definitely have an impermanent loss as well. The impermanent loss, we can do the opposite. So let's just quickly calculate it. So here we're gonna not compare ourselves to someone holding 100% Ethereum, but we're gonna compare ourselves to the limit order. And so we start at our beginning price, starting price 22.06, but now price goes down in that scenario. So we're gonna see the difference, impermanent loss grow. What is our bottom range? Let me see, because I forgot, is 2030. So we're looking for 2030. 2029 is nice. And DeFi-Lab states we have an impermanent loss of 6.26%. So if we have 6.26% less ETH than the limit order at that time. So 6.26%. 6.26%. 6.26%. Or the difference in Ethereum. So let's calculate. Where is the calculator? Check. Yes, okay, there we are. So DeFi-Lab told us it's 6.26%. So let's see. So the difference between 0.5 4619 ETH minus 0.453 ETH is 0.009 ETH. So 0.0089 ETH. So the impermanent loss to the bottom, it's important to see the difference in Ethereum because we want to accumulate Ethereum, and the difference we calculate in how much less Ethereum we can buy against the winner. Oh no, I did a wrong thing there. I hope everyone saw. I was comparing myself to the market order, the loser, but we need to compare ourselves to the winner. So we need to compare ourselves to the 0.492 ETH. And then we're almost done. So 0.492 ETH of the winner minus our number ETH. So we have 0.0301 ETH less. Okay, good. So these are our two impermanent losses. So impermanent loss bottom is 6.26%, and impermanent loss top is 7.28%. And this is very important, and this is one of the very, very cool things with liquidity pools, is that you can completely plan out the value of your liquidity pool before even opening it. So you can say, guys, I'm going to have an impermanent loss of 7.28% if price goes up, an impermanent loss of 6.26% when price goes down. Is that a sacrifice that I want to, am I okay with that sacrifice, with making that sacrifice to not have to decide on price action? So you can already see, like, this is a great way to diversify your portfolio without having the stress of trading. Because in trading, or you win or you lose. With LP'ing, you're always second. That's why I like to call it the awesomeness of mediocrity. Okay? Now, the very cool thing with liquidity pools is that you can try and optimize that mediocrity to still win in these scenarios, even without making a choice of direction. So what do I mean by that? What we're going to do now is try and optimize how can we win even against the winner in each scenario without having the stress of making a directional choice. Well, you already know it's based on the fees you generate. So the longer this price goes down in your pool, the more fees you accumulate, the less big the gap is going to be between you and the winner. So remember, we've got our impermanent loss to the top of 7.28% to beat, and we've got our impermanent loss to the bottom of 6.26% to beat. So if we want to beat both in every scenario, you always take the impermanent loss of the biggest. So if we want to win in every scenario and be the best without even making a choice of direction, we need to beat 7.28% in fees. Now, this is going to be the second important part of the presentation here, is how do we try and calculate, or how do we try and anticipate how much fees this range will give us. It's very important to know this is not an exact science because it will look at a backtest. So it will depend on a lot of things, or even shorter if volume is high enough without blowing out the bottom or top. Yes, exactly. So the longer price stays in your liquidity pools before breaking the top, because impermanent loss, you only solidify impermanent loss once you close your liquidity pool. As long as price stays in there, you've got time to make up for that impermanent loss. So you only solidify your impermanent loss once you close it, and I'm very sure Float Locker already talked about this during his presentation. This is how people get wrecked, because once you rebalance a very, very narrow range all the time, you bank that impermanent loss. Okay, so this is a completely different mindset on how to do it. So you only bank the impermanent loss when the range breaks. Okay, so what we need to do is we need to try and get a better grasp at how long do we need the price to stay in this range to beat both market participants? Well, we have some tools for that. And again, this is not an exact science. And there are better tools than others. And I think Aperture is working on a tracker or something like that as well. I know J. Call and his website, Builder Metrics, has a very decent calculator for that as well. But we can use DeFi-Lab. And I prefer DeFi-Lab to give you the theory behind it. Numbers won't be as exact, but it is a very, very good estimation in my opinion, and I'll show you why. So how do we estimate fees? Well, you start from the same position. So this is still your liquidity pool. This is still the liquidity pool that we opened. And if you go down, here you'll see a lot of charts. Can you guys see anything on the screen? Am I still sharing my screen? I hope so. So here you should see. Okay.
Yeah, I can still see it.
Yeah. Okay, that's awesome. Perfect. So here you can see the strategy backtest, and it's not as good as other strategy backtests like Builder Metrics from J. Cole, but it's gonna give you the theory that is needed really fast between Uniswap v2 and Uniswap v3. So in this strategy backtester, you'll see that not every day, so the green ones is the fees generated every day for the last 30 days, so last 30 days at an entry price. But you'll see not every day has a blue bar, because the blue bars is a concentrated liquidity. So it is your pool, it is your liquidity that is concentrated. And the green ones is Uniswap v2, so the liquidity provision from 0 to infinity, remember? So the days that, in the last 30 days, that the price was out of your range, it didn't calculate the fees in there. So that's why the strategy backtester is failing a little bit. And you can see it here, percent time in range is only 73. What you would like to see is 100%, because now you're not very sure of the APRs. It's not a very good estimation. So what we do here is we integrate the theory of Uniswap v2 and Uniswap v3, because what is Uniswap v3? Uniswap v3 is concentrated liquidity. So you take the 0 to infinity liquidity provision and you provide it in a tighter range. And I'll give you a visual. So these are your liquidity pools, top range here, bottom range here. So let's say we drag it out, right? We drag it out. Drag. You can see the concentrated liquidity multiplier changing here. So the tighter you go, the bigger the multiplier gets. Okay. The larger you go, the lower the multiplier goes. So if we hypothetically could go and give...
Is the comparison point 0 to infinity?
Yes, it is. So the comparison point is 0 to infinity. Why? Because Uniswap v2 gives liquidity from 0 to infinity. These are the first liquidity pools, right? So if you hypothetically could go from 0 to infinity here, it would go closer and closer and closer to 1. Of course, in DeFi-Lab we can't, but in the theoretical way, it would go to 1. So the more you concentrate your liquidity, the more the multiplier goes. And if you want to have a complete backtest of this accurately, is what you want to do, and I need to get in the correct data again. So minimum for us is 2031 and maximum is 2438. This was our liquidity pool. You can see we have a concentrated liquidity multiplier of 22.73. What does this mean? Our liquidity is 22.73 times more concentrated than Uniswap v2. So remember this number, 22.73. What is the APR of a Uniswap v2 pool, Ethereum USDC? It is 2.8%. So what do? We multiply this 2.8% with the liquidity multiplier, and we will get our estimated APR with 100% backtest on it, right? And this is how you can pretty accurately calculate your estimated fees. So 2.8% in a Uniswap v2 pool with a concentrated liquidity multiplier of 22.73. It gives you an APR, an estimated APR of 63.64%. There you go. Perfect. So we have that data, and this means that we can now calculate how long this 63.64% is an APR. So that is what we get in fees per year. Do you all know if DeFi-Lab's backtest is comparing the amount of in-range liquidity you're competing with? No, it doesn't. Or yes, it does. Let me check. I'm not 100% sure, but they have... no, they have daily volume, but not... Yes, liquidity density. You can have it here, but I'm not completely sure if their data is super accurate. Probably J. Cole's APIs are a bit more accurate, but I'm not sure. I'm just...
Yeah, the way...
Yeah.
Just to jump in real quick.
Of course.
So the way a lot of the backtesters work, okay, this one might be the most simple version, which is just vol TVL.
Yeah.
But the way some like Jake's work is they use an hourly snapshot.
Yeah.
Meaning it will compare you to the liquidity you're competing with, but just on like a snapshot basis. So there's a lot that can happen in between those.
Yeah, exactly.
Hourly snapshots, but it's more directionally accurate than this version. Of course, all of these backtesters are still useful tools, even if you're not getting fully granular data. But what Aperture is launching, quick plug, is the backtester we have will use all the swaps, ads, remove, basically every single event that ever happens in the pool. So you would be able to get a much more like granular, accurate comparison, taking into account the liquidity you're competing with, if you were doing this specific analysis.
That's really interesting.
Something worth calling out. Of course, for a lot of LPs, if you're LPing with a couple $1,000 with a liquidity, it's totally fine, and your strategy will still work with these quick and dirty methods that DeFi-Labs has, or the more sophisticated one that Jake has. But for the bigger users that want to deploy a bit more capital, I do recommend using the event log level of granularity, because this is how all the on-chain hedge funds do it. This is the only method that will give you kind of full confidence, because if you have a margin of error of 30 to 40%, which is what we've seen, if you compare hourly snapshot to event logs, that could be quite substantial if you're talking about 50K, 100K plus liquidity positions. Anyways, sorry.
No
Total
worries.
tangent. Tintin, back to you.
No, awesome.
Just wanted to talk about backtesters because I've done some research on these.
Definitely, and it's just a complete shit show at the moment to try and calculate the right thing. But whatever metric you use, and I'm really eager to try out the Aperture backtester soon then, because the more accurately you can do it, the better you can plan your position, obviously. But we can now, so what did we have here? Let's say arbitrary, 62.2%, something like that. It's possible that your backtester gives you another number, but basically with that number now, you can do a clean estimate of how many days you need to stay in range to beat that liquidity, to beat that impermanent loss in both ranges. What I do is I calculate it in both, but I rather my target, the target I really want to beat is, of course, the impermanent loss, the biggest impermanent loss, which in our case is 7.28%. So how many days do we need to stay in range for 7.28%? Well, we're going to do the calculation. So we're going to, and this is not super accurate, we're going to look at how many interest, so what's the APR per day? So we're going to, I can't find the word in English. We're going to divide it by 365 for a year. So we have it per day. And now we can, with 0.17% per day, we can now estimate how many days we need to beat that 7.8%. So 7.8% divided by 0.17 to 31, we'll need to stay in range for 45 days. So 45 days in range, estimate, yeah, to beat the impermanent loss. Perfect. Now, what is really cool is obviously once you can start and track your pools, I think everyone knows is Tracker. If it's APY Vision, if it's Reverts, whatever application you use, you can of course really fastly get the correct APRs, right? This is going to change day by day, of course, but especially the longer your pool stays open, the more accurately you can predict your median APRs. So especially first, if you're just planning, this is going to be pretty arbitrary, but we can state that we'll need 45 days in range. So let's say we've opened it, and this is how I like to put it on Tradingview, is we opened it the 14th of December, and we take 45 days. I don't really want to do the calculations, but I think it's like the 29th January, something like that. 29th. This is then the range you need to stay in to beat all other market participants. And this is for me, winner, winner, chicken dinner, because I didn't have any stress in how I wanted to accumulate my token. I didn't need to make a decision in direction. And for me, that's awesome because I suck at trading, but I'm pretty decent in trying to get the directions of the market. But timing and stuff like that is horrible for me. So that's why I really started to concentrate on liquidity pools. And so, is there anything I missed? I think so, yes, of course. So now that you understand all of this, our chads at our, and this is our little plug, is we've created a indicator that does all of this for you. So let's do low, high, entry, and it's gonna draw it for you. I maybe, let me go, yeah, let me go on another one, maybe. So let's do it for Bitcoin. So we did it for Ethereum now. This is the indicator, does it for you. So let's say I want to buy here. This is my bottom range. This is my top range. Here is the price that I open. It's going to calculate it automatically. So here you can see, you can then put in how much you want to, it's in French now, but you can put in $1,000. You can put in the APR, that is whatever your tools are using. So we said, let's say 63%. And it's going to give you everything you need. So this is the price of entry at 42.1. This is your limit order at 37852. This is your top range at 45374. The market buyer will have a value of $1,076 here. The liquidity pool will have a value of $1,015, which is a difference of 5.67%. This is our impermanent loss. Same thing for the bottom. And here we see our pool composition, which is awesome if you want to open a pool, right? So if you want to open a pool, you immediately know you don't have to go through Builder Metrics or through Uniswap Fish or whatever you need to look for. I immediately know if I want to invest $1,000 in this pool, I need 572.05 USD and 0.0101 BTC. We've put in the APRs as well. So here we put in the APRs, and this is whatever tool you want to use for them to estimate it. 63%, this means an APR daily of 0.1339% with an estimated 54 days in this range to beat the biggest IL. So the biggest IL is here, impermanent loss is 7.27% to the bottom range. So this tool automatically calculates 54.3 days needed to stay in range. So we then put in how long do we need to stay in range? 53. It automatically adapts, and now you can just say I need to stay in this pool until here. And I'm good, I've beaten all the market participants. And that's how easy it is now with the liquidity with this tool. But I wanted to share the logic behind it and the mindset behind it, without all the formulas, etc., with using free tools there. So that's it. If you guys have any questions, I have a hard stop at 7:30, but I'm happy to answer any things there, irregularities or whatever. Lots of math, yeah. Optimal Uniswap v3 LP position. Yeah, Felix, thank you for everything. By the way, David, you're still muted, I think. If you're there.
I'm back.
Yeah. Yeah, nice. Tell me, what was it a bit clear? Was it too confusing?
No, this is, I think, the most followable overview I've gotten on what I would call the accumulation strategy for LPing. As people know, there's kind of, LPs tend to fall into like a purely market making, yield seeking, token pair agnostic approach. And then along the spectrum, you can kind of slide more over to the other side, which is what you're doing here, which is awesome. I think this is how a lot of our users approach LPing, which is this like accumulation strategy. There's a token you want to buy or a token you want to sell, and through LPing you can, like, you know, always be second place, and in some cases you can win. I think this is a strategy not enough people on crypto Twitter or in the other places where a lot of mind space for UniV3 is being discussed or talked about. This isn't something that's brought up enough, in my opinion. So really appreciate this. I definitely want to write this up in a little tweet on Aperture side, because
that's awesome.
This is a pretty cool strategy. It makes a ton of sense.
Yeah, cool. So this is one of the most basic strategies, but it gives you all the building blocks. For me, it gives you all the building blocks to try and go for other strategies, which of course we don't have time to discuss here. But with this same mindset to try and beat impermanent loss, really understand what impermanent loss is, who you compare yourself to, you can do this in the form of market making, so trying to optimize for your fees. You can do this not only with Ethereum and a stablecoin, but you can start doing it with Ethereum versus Bitcoin, for example, where you compare yourself to someone holding 100% Bitcoin or someone holding 100% Ethereum. That's awesome for people that don't really know how to time the Ethereum run versus Bitcoin run, right? So there's a lot of possibilities here, and we still try and look for the how do you say it, like the boundaries there, together with our traders, to analyze like the best ways and the best places, best price ranges to get the most out of the volume there, etc. But I'm sure like Float really got really deep into that, and this is just a little other way to put those strategies in practice.
Awesome. Well, thanks, Tintin. And if anyone else in the audience is interested in giving one of these guest lectures, you can also DM me. We're always looking for new participants.
YouTube channel. Yes, but it's in French. That's why I don't plug it. So our community is in French. I have a YouTube channel, but for the French and the Twitter as well. I almost do everything in French. Where will this recording be posted? I will post it in the concentrated liquidity one. Just in a DeFi dojo. I think that's the best way to do it. It's where I hang out the most. So I can understand most of French. Okay, awesome. So I'll just link our YouTube then. Little plug here. It's where we look at the theory. or Daniel, can you maybe link to our YouTube? No, I can't find it. It's okay. So this is me explaining Uniswap v2. This is also our channel. There's 2 videos there, and then my Twitter I can share as well. My pleasure. Yeah, I can't log in now actually, but I think it's Tintin. I think it's this. You should find me on Twitter. It's the same PFP. You must understand Belgian French. Yes, it is Belgian French. It's not my main language. Yes, thanks, Daniel. Awesome. All right, if that's all, I'll leave you guys to it. Just know I'm hanging around sometimes in the Aperture Discord as well, so you can always tag me if you have any questions on this one. Always happy to answer. And otherwise, I'm hanging around in the DeFi Dojo, or of course in Cryptologik, but that's for the Frenchies mostly. Otherwise, it will be difficult to understand, I think. And you, David, thank you for this opportunity. It was a real honor to share the stage with Float after Float and Jake, and always happy to do some more. Thanks, Float. Means a lot coming from you.
Awesome. Thanks everyone. Tune in next week. Well, do I have one scheduled?